Hello, good morning, and welcome to our third live SDS webinar. My name is Christopher, and I work with our clients and new business at SDS. And what I really wanted to do is bring you some content from our team, from our technical teams, from our software, and also from now today, our consultants. With me today is Andrew and his team of experienced consultants, Annie Wilson, Greg Warner-Harris, John Stevens, and Vicki Appleton. So,
good morning, Chris.
Andrew,
Morning.
good morning. Take us back to what we just did in our first two and what we wanted to cover today, how we're leading on from that.
Yes, good morning, Chris. Good morning, everyone. So yes, in the last couple of webinars we talked about the possible impact of a reduction in sales price and what effect that would have on viability and appraisals, and looking at the kind of the small changes in sales values have a disproportionate effect on value on land or your offers or your gross margin. So and the main reason for that was really to, the sector, the affordable sector, is more exposed to the kind of sales market than it probably ever has been. So it's kind of taking a look at that and understanding that from my background is private development and used to be a land buyer, so kind of being at the sharp end of understanding what kind of can happen in the downturn back in 2007, 2008, and really to show the effect on a land appraisal. And then we did a bit of mix optimization, looking at an investment model and the effect of cross subsidizing from one tenure to the other. Yeah.
So when we looked at that 5 to 10%, at the time it was only Savills saying that was their prediction. JLL have since doubled down with them. So now we have two of the big research powerhouse analysts agreeing.
Yeah, so they've joined together to have a statement to say underpinning that position. So scenario one is to say, yes, there could be a 5% short, sharp downturn in sales values. And then the scenario two is to have a 10%. It all depends how quickly we can get back to norm, if there is a norm. So it all depends on how the sentiment, how the confidence out there with people doing these large purchases over not just this year, but obviously going into probably next year as well.
Okay, so I think we can probably agree that Savills and JLL are probably in the right ballpark here. But what I would really like to do is delve into a regional effect and get out of the broad brush 5 to 10%. John Stevens, will this be limited to London and the South? Or what are you expecting at the moment in the South?
Yes, most people in the southern region are in line with where Savills and JLL are. But our view is obviously across England, and in the north, yes, there is some concern about it, but there always has been in terms of chasing what happens further south. There already was starting to be a slowdown already. I'm interested in not just the southern perspective, I'm interested in how it's seen overall within the overall sector, because Andrew's right, developing housing associations won't be looking just at short-term position, they'll be looking at long-term program position, and often schemes going on for several years. And written into the development agreement will be an adjustment based on house prices, and they may have made assumptions about growth within that, where in fact we're facing a short-term period, perhaps of reduction. But overall there's a lack of supply, so the market should pick up after any initial drop. But I'd be interested to hear from the others, to be honest.
Vicki Appleton, can you give me some comments on exactly what you're going to be expecting in the north right now?
Okay, well, I think there's going to be an inevitable impact on sales values, but the north obviously covers quite a huge geography. We've got very contrasting housing markets, so what happens in Cheshire may be slightly different to what happens in East Lancashire, for instance. So I think there will be an impact, but it's difficult to sort of envisage the extent of that until we know how long we're in lockdown for, and how long it's going to take to build back consumer confidence in the market.
Okay, great, thank you. And Annie Wilson, have you got anything to add to that? Are you also northern based?
No, I generally cover the sort of southeast home counties, so northern London region. I think everyone's really covered it. I think one of the key things that we need to recognise is obviously experts are advising and predicting that things are going to bounce back and the pent up demand is going to be realised. Obviously, that's predicated on what's going to happen with unemployment levels as well, and there not being an affordability challenge, increased challenge after we're out of this lockdown. So it's a period of high levels of uncertainty, it's fair to say, but I believe there's also an opportunity as well.
And Greg Warner Harris, shared ownership sales, that's your specialism, 5 to 10%. What are you going to expect from that, and how will that affect your schemes and what you're doing?
Yeah, I mean, 5 to 10%. I should say the Knight Frank report is a lot more optimistic. They've downgraded to 4% overall. Sorry, 3%. Whereas the Centre for Economic Business Research is saying 13%. So I think the message is we don't really know, but something is going to happen. The Centre for Economic Research also suggesting actually that the strong influencer will be the recovery of the economy and how well the job retention scheme is working. So they're actually saying the north is vulnerable because of the manufacturing in the Midlands. So I don't think we're going to really know, but we know something's going to happen. One thing that is encouraging is that, and it's been alluded to already, they're all reasonably certain that there'll be a quite sharp bounce back, because it's not a structural financial issue with the economy, it's a health matter. And so I think the things will be coming back. So while, from my perspective, I'm just thinking from 10 years ago on Lehman's, we got through that. There were some mitigants we put in place. In the immediate term, if clients have got shared ownership schemes live, Section 2.8 of the Capital Funding Guide makes it quite clear that Homes England will be sympathetic to asking for grant to flip 10 years, providing you've done your market research and your demand to back it up. And so I feel that we'll get through this, but we've got a few bruises to suffer in the short term. Long term, as it's been said, their demand is still there. And interestingly, if I just go back to Lehman's, I had quite a large shared ownership program I was selling at the time, and we had a scheme that would have just flown out the door that we launched a month after Lehman's, and it staggered, and we couldn't. We were really scared, but we went back to basics. We've done some real marketing, we've done focus groups, and what we found, it wasn't a demand issue. The demand was still there. It was just that people were scared. They were scared about losing their jobs. They were scared about negative equity because prices were going down. So what we did is we adjusted the product to suit those issues, those fears, relaunched into February, and it flew off plan. So I think the message is do get underneath what your market is telling you and the reasons for why the market's not moving, because as professional marketeers we can generally deal with those issues so long as we know what they are.
Yeah.
Thank you. So bigger question. Do you think the affordable sector is ready for this? John Stevens.
The affordable sector has been subject to a series of challenges, and this is just another. So we've had rent reduction, we've had supporting people funding disappearing, we've had rent reduction was a big one. We've had Brexit. What are the challenges of Brexit? Hopefully there is repeat agendas within housing associations saying, oh, yet another crisis, let's get together our crisis group and then go through the same processes. Am I cynical? No. It's yet another issue for the housing association sector to deal with, and hopefully they are now well versed with dealing with these challenges. They've got some succession plans in place, hopefully, and they've also got some capital set aside in terms of revenue support. That's probably easier for the larger associations to do, the smaller associations, who tend to be the more specialist organisations, may be more challenged by this, because it's often the smaller associations who are delivering the supported housing, the specialist housing, the homelessness support, the temporary accommodation, and it's really they have been on the front line in terms of supporting people with homelessness. So are we ready as a sector? We're quite a diverse sector with large players, medium and small. It's how we all work together, isn't it? That's the message from the government, is actually this is a challenge for all of us in society, and how we're going to come out of it is how we work together in the future. I can go into more detail, but I don't want to dominate the conversation. I want the others to actually contribute as well. So.
Okay, great. Let's move on to Annie Wilson. Annie Wilson, do you think the sector is ready for this right now?
Yes, I do. I think obviously in recent years we've seen an increase in the level of open market sales activity that medium-sized players have been undertaking. So this certainly presents a significant shift in risk for some registered providers, as well as other registered providers actually diversifying in other income generating activity, student accommodation, commercial property, etc., to cross-subsidise their mainstream social housing. So as per directed by the regulator, they should already be modelling the impact of a significant downturn in the market and ensure they have their mitigation strategies that are well developed, up to date and be implemented. So theoretically, I would say, yes, they should be ready. They are ready. Let's not forget as well that Savills and JLL have also already said that they don't foresee a negative impact on the underlying value of affordable housing. And that's really critical because it ensures that RPs remain in a financially strong position to continue to develop, and should therefore also have a sufficient buffer in their business plans to kind of sustain the blow, the temporary blow.
Okay, and a slightly different take on the same sort of question. Vicki Appleton, if you were in the driving seat right now, development director, what would you be doing?
You'll be reviewing the whole of the programme, the actual committed development programme and the pipeline programme. Obviously stress testing, business plan, working with finance colleagues, looking at individual scheme viabilities and appraisals, reworking, probably modelling, reductions in sales value, extended sales periods, extended construction costs, increased development costs as a result of the sort of stopping and starting on site. That you'd be looking as well to your board in terms of the appetite to future development and sales, keeping the board on board. And just sort of engaging with colleagues and keeping people in the loop. It's all about communications in times like this and sharing good practice with colleagues to see what other people in the sector are doing situation.
Absolutely. Now, John, earlier you touched on something when you mentioned smaller housing associations. The ones under 1,000 are the most immediate concern. They don't have the buffer, the financial clout. If government cannot give them the support they need, what are their options for survival?
That's a day-to-day challenge for the small associations. They've retained probably the social purpose that they were set up to deliver affordable housing and probably some form of specialised provision. They are often the most challenged and often providing particular sector services such as the homelessness support, the supported housing. I'm hearing from those contacts in that sector that they've all cooperated with the stay in sort of agenda to get the homelessness people off the streets into temporary accommodation. But their big question is where next when this opens up again? Where are those people going to be housed? Where is the move on accommodation? And I think what Greg and others talking about the ability to flip tenures for large housing associations working with Homes England. Yes, maybe programs need to be looked at that some of those tenures can now be used for more urgent purposes. And this is where the small associations could potentially work with the larger associations, and there could be a regional link up in terms of that move on accommodation being available in the sort of short to medium term whilst other plans are put into place.
Okay, so obviously we're going to go into cross subsidy and other tenures and tenure flipping, but before we do, increased grant funding levels is also clearly another way for this to start get moving again, whether they use that grant to buy up stock from existing builders, which can then get the system moving again and free up capital, or whether you use it to prop up the cross subsidy model. I have approached Homes England. They were all very responsive. I couldn't believe it. Usually I reach out to a company and one person responds. I have 5 people responded. They couldn't talk yet. And obviously they've got a lot of figuring out to do at the moment. And I have every faith that they will come on here when that's done. But in the meantime, what are your expectations? Do we need this grant? How crucial is it? And how would you be planning forward, not knowing the exact state of affairs? I'm going to start with Annie Wilson.
I think grant is almost certainly required. We're already in a position where the opportunity costs in most locations of flipping private sale units to rent or shared ownership isn't even, the grant isn't even touching that cost. So grant will be critical. It'll be critical particularly to underpin the viability of projects where they're already at the cusp of viability, perhaps estate regeneration projects. But the devil will be in the detail. Obviously, let's not forget the new housing settlement that was announced before we're in the position that we are in now. 12 billion, that's a huge success story for the sector. But ultimately, how that will be deployed is a question that we need to be asking Homes England. And we need to be focusing really on optimising the outcomes, not just propping up the housing market, because that's ultimately what the grant is there for.
Okay, so let's move on into flipping tenures. Rent to buy is currently rent to home buy. It has currently been sold as a potential magic bullet. Vicki, Appleton, what's your views on that?
So obviously I can't speak for the whole of the north, but my experience up here is that there's very smallish taker in terms of rent to buy, because in some of the areas up here it's sort of more financially viable to buy a smaller share in a shared ownership unit than it is to enter into the rent to buy market. So I think that's quite a specialist market in terms of sort of try before you buy, and the whole thing at the rent to buy is identifying the right purchaser for that unit, because obviously they have to have an aspiration to sell and have the circumstance to be able to save up to buy that property ultimately. So I think in the north, shared ownership is the sort of more preferred and well-known product for the market.
John Stevens, rent to shared ownership, is this a potential new tenure?
It's a tenure that's been tried. I think what we should do is make a distinction between what you've described, which is rent to buy, which is currently out there from Homes England, which is people on an intermediate rent up to 80% of market, then being able to hopefully save for a deposit and then buy the property outright. So that's rent to buy. Rent to home buy is people renting on a discounted rent, the same model for a few years, but then being able to take a shared ownership purchase of the property. This was tried in London with the London Living Rent, which was seen as an innovative tenure that a lot of housing associations looked at, but not many engaged with. And rent to home buy in the wider sector has disappeared. But personally, I believe it's a better step to go from intermediate rent to shared ownership than it is to challenge a household to go directly into 100% buying the property. And I feel this graduation of a tenancy is part of the future, in the same way that housing associations being supported to flip between tenures of stock is the future as well. I don't know if Greg has a view. Or...
Yeah, I definitely support that. I think the previous models of the rent to buy, and there's been various iterations, certainly from my experience, haven't been that great. The take up has been slow in terms of buying. Now, part of the reason for that was because at the time prices were accelerating away. and that stopped people getting into the ability to be able to buy. Now we're not there now, so it might be more doable. But particularly if the model you're suggesting, John, is that we use the rent to home buy as an intermediate step. I think we just need to think about how we rebrand this. I think it's a little bit of a clumsy model, but it's got great potential. And certainly, if the grant is such that it's viable just on the rent and not a requirement to flip later on, then I don't see why a lot of housing associations don't pick that up a bit more in order to come through.
Andrew, you are dying to say something on this.
Yeah, I was just noticing some stats here. I was saying 31% of kind of new homes are standing empty from the private sector. And I've also kind of been reading that Halo have done a deal with, I think it's Crest Nicholson, to buy or help or buy lots of their units and then turn them into a shared ownership kind of model, which they're rebranding as home buy. So do you think it's a kind of a lost opportunity or an opportunity for housing associations to do some deals with some private developers and take these standing units off them and then put this back out into the market for a shared ownership product, because their Halo model is very similar to the shared ownership model, but they're just taking it from the private sector?
Is that pointed at anyone in particular?
All of them.
Okay, let's start with Greg.
Yeah, just on that, I'm doing a little bit of work with a small for-profit housing association that is looking along those lines. They're having a slightly unusual complication, as much that we talk about values. They're struggling to get values because of the uncertainty, and we know that values are incredibly cautious when they're in this situation, and some of the down values from the Lehman's era was due to that cautious approach from the valuers, not the demand-led values. So, but certainly people are doing that. But also on top of that, I know of housing associations. I mean, let's face it, we are long-term businesses. We'll get through this. And we have got cash. We have got cash, and so
balance sheets are very good, aren't they? Yeah,
absolutely. So let's be blunt. There will be some fire sales, and we should be able to take the opportunities to forward our social purpose. And we're in the business of building homes. Yes, we're in the business of surviving, but in the longer term, we're in the business of building homes and giving people homes. So, I feel that there's absolutely opportunities here.
I would echo that, and also add that I don't think it's just Halo that are actually, use it. We're having discussions with developers to acquire bulk unsold private sale units and flipping them to affordable. I think this is happening. We're seeing, obviously, in London as well. The GLA is having discussions on a wider scale about just that. The challenge will be, exactly as Greg says, the valuation of those units, and actually, I dare say, the expectation from developers as to what they can get for those units in terms of a price, and that's going to be the sticking point. Clearly, an RP shouldn't be overpaying. There should be a reduction, a discount by bulk purchasing, but the challenge will be at what discount.
The other thing as well to be mindful of is space standards and quality of accommodation, because a lot of the private stock, the space standards really don't meet our requirements. So then again, it's been quite selective in terms of those bulk purchases and not just buying anything for the sake of increasing stock holding.
Yeah. Definitely,
yeah. Okay.
Can I make a point, Chris?
Yes, please, Greg.
Yeah, just a very small follow-up on the point that Annie made about developers being realistic, and I just feel that may be where there's going to be a problem this time round compared to the Lehman's one, because all the expert values are saying this is a short-lived bruising. There will be a bounce back, so there may be developers who are, landholders who are willing, and developers are willing just to sit on their product and not take the offer. So that could be the challenges when we're out there trying to buy.
A stagnant market, that's something that could affect this in a bad way. It could mean that housing associations aren't able to capitalize and give themselves more longevity. That what you're saying, Greg?
Yeah, I think what it is, you know, no one wants to sell at a loss, do they? You know, and so if a developer is thinking, well, actually, if I just sit tight, it's better to sit tight than to sell my product at a discount to a housing association. They may choose to do that, particularly if they've got liquidity to do it. It may be some of the smaller developers where there'll be opportunities.
Yeah.
Okay, I'm going to take us on to building and construction. Okay, I'm not asking for any forecasts here. Let's say you have a scheme which is under construction right now. It's had to stop. What are your worries? How are you dealing with this on a day-by-day basis, John Stevens?
Right, if you're dealing with a site that's been closed down because of the restrictions, your thoughts when you're opening it up, probably your first thought is it secure? In any lockdown period, who has the contractual liability to make it secure? How is that going to be monitored? And the first time you open it up, you need to do a detailed inspection to actually see, have any issues arisen? Has there been any deterioration on site? And you also need to obviously organise your project team accordingly with their disciplines, but you've got all the challenges currently of social distancing. So you won't all be gathering for a site meeting. Perhaps the employer's agent will be doing the inspection, and then you'll be doing a site meeting in this scenario of video conferencing, where you'll be talking about how we move forward, what subcontractors are able to access the site and what number, can you get hold of materials, and is that going to extend the contract period? And how does that come into the contract arrangements for any consideration of LADs, which would be, yes, rather challenging. And then obviously that goes all the way through the food chain, back through IMS to Homes England, who are going to have to be informed about changing of key dates. So that's the sort of scenario that we're in at the moment. I don't know if anyone else wants to offer any comment on that.
Vicki?
It's just obviously, I would say the development team, and in particular the clerk of works and those staff, they're really on the front line. We need to be mindful of the health and safety of those team members and make sure that's the key priority. And obviously, as John said, to recognise impact on delays and keep Homes England informed of those delays. But yeah, the health and safety of the team and the construction site are for me, is pretty fundamental.
Annie Wilson.
Nothing really to add other than, I suppose, on a wider sense, looking at your contractor risk exposure in greater detail, making sure your due diligence is up to date. Are there any red flags? How are you going to address them?
Okay. I'd like to move us on to something which is a source of contention. Savills have recommended one of the things that could be done to solve this problem, to make the cross-subsidy model work better, is using modern methods of construction. And I always like to look at the sour lemon-faced Andrew.
Thanks,
but they
Chris.
seem convinced it can provide cost savings and time savings. Andrew, what's your problem with modern methods of construction?
I don't have a problem with it. We've been talking about this last couple of days. It's quite interesting. But all I'm saying is it's not going to affect what we are in now. Yes, you should have a team. Yes, you should have an expert panel working with your contractors of improving your product line. But that's not going to affect what you're going through now and viability. So that's why when you brought it out, when we discussed it the last couple of days, I just think, yes, that's important. And that's where the sector is going for more of a product line based manufacturing. Yes, but that's not going to affect the real issues now. And if you've got teams furloughed and, the real challenge is really getting the right structure around what's affecting you now and data coming back on a kind of weekly, monthly basis to understand what things are going to do and change. So yes, it's important, but that's why I always laugh and hit my head when you start talking about modern methods.
Is this the bus that never arrives? Is this the thing? That's what it seems like to me. John, I keep seeing these videos. We printed this building in 2 days out of cork from wine bottles. This is the future of building. Why do we never see this stuff coming through? John Stevens.
It's like the carpetbaggers coming to town. I've been through this circle before where you're promised houses in a week or whatever, or they're going to be delivered in steel containers from China or something like that. I've been, yes, subject to evaluating this before for various housing associations over time. Modern methods of construction, it needs volume for it to happen. If it was the panacea of saving cost and saving time, the house builders would be doing it, wouldn't they? The major house builders, and some of them are looking at elements of it coming through. If it is the panacea to actually build homes in factories, house builders would be doing it, and local authorities would be getting behind it, and government would be getting behind it. We had the experience of prefab production with the housing crisis after the war, and some of those have well stood the test of time, and are liked by some of the residents. But in terms of my experience of MMC, it's exactly what you say, the bus that never arrives. Lots has been offered, and when you actually commission work, you find it's delayed, and if you'd gone down the traditional route, it would have been delivered quicker. So sorry, it's a bit of a cynical view, but if it was the panacea, the house builders would be doing it, wouldn't they? Yeah. But perhaps.
Comment?
Yeah.
Yes, Greg.
Yeah. So you said, is it like the bus that never arrives?
It's a loaded question. I know.
Yeah. Okay. Well, my view is it's going to be like the London bus. It never arrives, but then they all arrive. I've been in three off-site built homes that are fantastic from 3 different suppliers. Good to go. The prototypes were coming in about 5% more than trad. So it's exactly as John says, it's volume. And they're going to come in the next 5 years. You'll see them en masse. I am happy for that prediction to be minuted.
Vicki Appleton.
Comments about volume. It's all about the volume, and even working together, trying to agree a common specification when there's a number of RPs working together. It's just I've been there like John, and it's never actually happened, and schemes that have been involved in, the actual cost of it has increased more so than it would have been with the traditional development, and the time saving hasn't necessarily helped with that cost impact. So it's not been as financially viable as we are led to believe from my experience.
Right. Annie Wilson, your experience with MMC?
I don't really have that much experience with it, in all honesty, but obviously at this current stage, viability is key, and where you're exploring opportunities that arguably are probably more costly when values are going the other way. Does it make business sense? You know, long term, it's something that RP should always be looking at. It should be exploring ways to be more efficient. But is it now? Is now the time to be jumping on that one?
And the other thing to mention as well is about mortgageability. So from a shared ownership perspective, a lot of these new products, that they're not proven to be mortgageable. So from an RP perspective, it's all right as a rented product, but if you're looking at a 50% shared ownership program, then you wouldn't want to risk putting something to market that's not mortgageable.
Okay, sure. I thank you for all of your. Oh, John.
I just want to add something that I think there's, pardon the pun, I think there's a halfway house here, whereby what is needed is a well-insulated structure delivered to site, not necessarily fully finished, because then you are including the local subcontractors in terms of finishing trades, etc. So I think there is a place for it if you're delivering a well-insulated structure to site. You don't have to deliver the whole finished article. I think that might be the future. Yeah.
Okay, so I'm glad you said that, John, because I'm going to take this video and all of these comments and I'm going to send it to MMC providers, and I want to invite them on to respond. I think it's only fair. That's a future one. Okay. Just the solutions, and let them, say their part on it. But yeah, I think this has been pretty pretty good. I'm going to open up for a Q&A from anyone watching this. Any questions right now, please do send them in and we will get through them. But we have just hit the 30-minute mark, and what we don't want to do is keep people here for too long. But in the meantime, while we just wait for some questions to come in, there's been talk about an SDLT holiday. What are your thoughts on this, Vicki Appleton?
I think potentially it's a good idea. It's just the government at the minute are offering so many sort of financial measures. I'm not quite sure how high that will be on their agenda in order to do that. And it may be that if something is offered, they target it to the lower end of the SDLT scale to benefit those people on the lower salary bracket rather than the sort of higher end.
Okay, and Annie Wilson?
Yeah, if what the experts are saying about there being a pent-up demand, certainly an SDLT break is going to provide an incentive to start to bring that transaction and that activity. But as Vicki said, it needs to be targeting those that are going to be impacted by the current position. So those with the insufficient deposits, you know, it's likely that the bank of mum and dad are going to be a bit more cautious. The ability to raise a deposit required for first-time buyers is going to be more acute than it has been in recent years. So equally, I do think there is also an argument to extend it to kind of possibly the sub 500k mark, given the affordability challenges in slightly higher value areas and the ability to kickstart the market and revitalise things. But yeah, it's going to be a challenge as well, I think.
Greg?
Yeah, I think any help is welcome. But in terms of who the holidays target at, I think I agree with Annie. Let's perhaps push it up a little bit, because what we need to remember is the downstream economy of house building is tremendous. Okay, so if we're trying to get the whole economy going and getting people who are in danger of losing their jobs into a more secure situation, then yeah, house building is a great way to do that. So maybe in the bigger picture, it's yes, not just target to the immediate people who need it, but the wider sector, because I say, you know, the spin-off benefits are quite large compared to other sectors.
Andrew?
I think definitely. I think it's. I've heard it being posted around for the last couple of weeks, and I think it's definitely needed, not just targeted for everybody, just to get everything moving. It's going to be very slow transactions and very painful to go through the process. And obviously, Treasury take a lot from this, so it's not going to be a long-term thing. It's just going to be a short-term impact, and I think that will definitely give a bit of help and support. To give the confidence to go through this position in the short term. Remember, Savills, are still predicting or standing by their predictions for 5 years. So they're still saying that this either the 5 or 10% hit immediately will recover sometime slowly next year, but in their 5-year prediction is still a 15% increase in sales values across the sector. So, I think a short-term hit to get things going and to give help confidence, I think that's definitely required. Yes.
Okay, thank you very much. But I think we've come to the end of this discussion now. We haven't had any questions in, but that's absolutely fine. I think we've done quite a lot.
Chris, can I ask one more question, actually, rather than just saying yes to it? Could we say what else do you think is required that the government could do from the panel? If there is anything else there that is a good suggestion, that might be a good.
Sure. Yeah, absolutely. Homes England, what do we need from them? Anyone?
I was thinking that we've been talking about market sale and also that coming down the 10 years into shared ownership, but in these circumstances where we're hearing about lockdown and pressures and people losing their jobs, internal pressures, are the sector being supported with things like mortgage rescue? Because if there's household challenges, whether it's your relationship or whether it's your job or whatever. I know in the past housing associations have been supported with mortgage rescue, turning properties into rented products or reduced shared ownership values. But I'm just wondering if that's one part of support that could be offered by housing associations in the shared ownership and sales market. I don't know what your thoughts are, Greg.
Yeah, I mean, mortgage rescue. I mean, we had programs along those lines after Lehman's as well, didn't we? And that, you know, there's a lot of associations getting involved in that. The one I was with at the time, we did some. So I definitely think that's the one area where, yeah, we need to perhaps refresh that sort of initiative. In addition, I don't know how, but if Homes England could engage again with the lenders, the Finance England, just to keep the mortgage supply going. I was talking to a specialist mortgage advisor yesterday who deals almost exclusively with shared ownership. Good news is he's done about 120 assessments since April, so he's still got some activity. The downside is the 5% deposit lenders are shrinking a little bit. He's still got some on the books, and he's been talking to them, so there's a little bit of caution going in there. I'm nervous for the people in the rural areas who are still doing the 80% restricted staircasings. I think they will be in trouble. They were after Lehman's. That product's past its sell-by date in any case, in my opinion, probably just my opinion. But certainly, if Homes England can engage with the lenders just to keep and after all, you know, lenders need to lend to make money. So providing they can get the confidence and insurance to keep going, I'm sure they will. But yes, some intervention there might be useful.
Okay, Vicki, Appleton, what do you want to see from Homes England?
For them to support some of those contractors that are going to struggle within this, because inevitably people are going to go into administration. There's going to be stalled sites there, so I think Homes England have got a facilitator role there to play in terms of getting those stalled sites up and running and working with the RP sector to deliver those sites. And then we've also discussed earlier about the requirement for increased grant funding and the whole thing around flexibility of approach. So being flexible in terms of tenure switches and letting us do what we need to do rather than be quite stringent in approach.
Andy Wilson?
I think it's been covered succinctly from the board. I think the other extra opportunity that the sector is facing now is actually looking at key workers. You know, key workers have been celebrated quite rightly in this period, but there's also actually a real opportunity to reinvigorate that key worker new housing supply, which somewhat kind of fell to the side in recent years, and actually redefine what key worker is, for RPs to take a more proactive view in understanding who their key workers are in their areas and how they can actually address their housing needs. I think that's just a huge thing to celebrate and positive to come from this. And so from Homes England, I think is we would need to have some greater clarity about their support to address this need, and equally kind of parameters around how RPs can do that.
Thank you, Andy. Back to you, John.
Yeah, I just wanted to add before we close down that this opportunity of kind of reflection as to what housing associations need to do, I wouldn't want to end this without saying housing associations also need to look at succession and also bringing young people into the sector. So there are issues around unemployment coming out of COVID. What housing associations could do is actively support young people coming into the sector, whether that's graduate, apprentices, or support workers across the board. I think housing associations should take a view about succession training and the next generation to engage with delivering more affordable housing. And this is an opportunity to think about bringing young people who will be challenged by this event and bringing them into the sector, because it's a great sector to work in. So I wouldn't want that opportunity to be missed.
Thank you. Thank you very much. Now, if Andrew, do you have anything else you'd like to cover for now, or shall we wrap it up?
No, I think that's covered most of the points. Yep.
Excellent. Well, everyone watching right now, thank you so much for taking the time to be with us today. I hope that we've been able to help you in your day-to-day job at the moment. Obviously, These are all consultants who work for us and are actively helping other RPs and local authorities. We will be having more webinars in the future, so please do look out for them.
Explain next week. So, sorry, do you want me to-
sorry, yes, Andrew, tell us what we're doing next week.
Okay, so following the theme next week, I think we're going to be talking about sales tracking using one of SDS's products, SQL, seeing how important it is to get the attributes correct and the different views across that product, and then getting the reports coming through so we can show the different elements of best practice, perhaps, of where we are tracking this, because obviously data information is going to be crucial of keeping it up to date, and then joining that together with the development teams and the sales teams. And then Greg is going to do a little presentation, aren't you, Greg? About.
Am I? Okay.
Yes, yeah, exactly.
Always delighted to present to you, Andrew.
I can put you on the spot so you can't say no. So about branding. So he's going to do maybe a 10-12 minute little presentation about the importance of branding, and perhaps some of his experience from the past that could help, and just what would work in this environment. But yeah.
So we're focused next week on sales. How do we attract them? How do we track them? Brilliant. Okay, sounds great. Everyone, thank you very much. I'm going to cut this off now, and we look forward to seeing you again. Bye-bye now.
Thanks, guys. Thank you.
Keep safe.